We've all heard the advice, max out your 401k every year. It's the best way to save on taxes. But what if I told you that strategy could actually set you up for higher taxes in retirement? Here's the reality. Many high-income earners unknowingly create a tax time bomb in their 401k. And when the IRS comes knocking in your 70s, there's no way to stop it. Hi, I'm Mark Wisniewski, president of Southern Incomes. For over 20 years, I've been helping retirees turn their savings into tax-efficient income plans so that they can enjoy retirement without fear of surprise tax bills. In this video, I'm going to show you why stuffing every dollar into your 401k is not always the best move, and the strategies that you can use today to avoid overpaying taxes later on. If you find this helpful, like and subscribe for more tips on building a smarter retirement. Part 1, why maxing out feels right, but it could be wrong. For decades, we've all been taught one golden rule: max out your 401k. This is what most people do because it feels like a smart, responsible thing. You get a tax break today, your money grows tax deferred, and you don't have to pay taxes until you take withdrawals in retirement. But here's the problem. Every dollar you pull out later is fully taxable as ordinary income. And for high-income earners, that tax bill can be a lot bigger than they ever expected. Let's take an example. Imagine you and your spouse did everything right. You built up a $2 million 401k over a 30-year career. Let's face it, you're excited for retirement until you turn 73 and the IRS forces you to start taking money through acquired minimum distributions, or RMDs. Your first RMD, maybe it's around $73,000. That $73,000 doesn't come tax-free. It's added to your Social Security, any pensions you have, and any other investment income. Suddenly, you're pushed into a higher tax bracket. Worse yet, up to 85% of your Social Security benefits could now be taxed. You might trigger Medicare premium surcharges, also called IRMAA penalties, and you lose the ability to control how and when you draw down your savings. This is what I call the 401k tax trap. You defer taxes for decades only to pay them back later, possibly at higher rates than you paid back during your working years. Part 2, why high earners are most at risk. If you're a high income saver, this trap is even more dangerous. Here's why. The more money you put into your 401k, the more taxable income you'll be forced to take out later. Think of your 401k like a balloon. Every time you contribute to it, you inflate it a little more, and at first it feels good to watch it grow. But eventually that balloon gets so full that when the IRS sticks a pin in it, that's your RMDs, the tax hit explodes. For someone who aggressively saved, those forced withdrawals can easily exceed what you actually need to live on in retirement. Okay, Mark, what does that mean? Well, let me put it to you this way. You turn, say, 85 years old this year, and your RMDs from your big 401k this year is $119,000. There's not too much maneuvering you can do at that point. You're going to withdraw that $119,000, be taxed, and the IRS is going to have a big payday due to your poor planning. And if Congress raises tax rates in the future, which many experts believe is likely, you're going to owe even more on that deferred income. Instead of enjoying a tax-free golden year retirement that you imagined, you're facing bigger tax bills and, importantly, fewer choices. Part 3, the smarter approach, tax diversification. So how do you avoid all this? The solution is tax diversification. Instead of putting everything into a tax-deferred account like your 401k, you spread your savings across 3 tax buckets. Bucket 1, tax-deferred. That's your 401k or traditional IRAs. You still get a tax break today, but withdrawals are going to be fully taxable in retirement. So use this bucket, but don't let it grow so large that it dominates your plan. And if your company has matching, you could probably substitute the term free money for matching, something you might want to look into. Bucket 2, tax-free. Roth IRAs, Roth 401ks, HSAs. You're going to pay taxes on contributions now, but future growth and withdrawals are completely tax-free. Roth accounts don't have RMDs, so you keep control. Bucket 3, taxable, like a brokerage account. There's no upfront tax breaks, but you get lower long-term capital gains rates. Plus, there are no forced withdrawals. You could take withdrawals at 65 or 95. By spreading your savings across these buckets, you create flexibility for your retirement. In our earlier example, instead of turning 85 years old and having the IRS force you to take out that $119,000, maybe due to diversifying your base, the IRS's RMD for you is going to be $44,000. which could possibly cut your tax rate substantially. And when tax rates rise, or you need to avoid those IRMAA surcharges, you can pull from tax-free and taxable accounts instead of being forced to take big taxable withdrawals. Think of it like having multiple spigots on a barrel. You get to choose which one you open depending on your needs and your tax situation each year. Part 4, why Roth contributions deserve a closer look. If you're still working, this might sound counterintuitive, but paying taxes now could save you far more later. Yeah, you heard that right. Here's why Roth accounts are such a game changer. Withdrawals are 100% tax-free in retirement. And there are no RMDs on Roth IRAs, so you stay in control. You're locking in today's historically low tax rates instead of gambling on what rates might be decades from now. If your employer offers a Roth 401k, it's worth exploring, even if it means you don't get that upfront tax deduction. And if you're over the income limit for Roth IRA contributions, well, consider strategies like a backdoor Roth IRA or even Roth conversions during lower income years. I tell clients this all the time. Would you rather pay taxes now while your rates are known or later when rates could be higher? Part 5, what if you're already retired? If most of your money is already in a 401k, don't panic. It's not too late to improve your tax situation. Here are 3 smart moves for you to consider. Number 1, strategic Roth conversions. Gradually move portions of your 401k into a Roth IRA during years when your taxable income is lower. This reduces your future RMDs and builds tax-free income for later. 2, qualified charitable distributions or QCDs. If you're over 70 and a half and give to charity, you can send IRA withdrawals directly to a charity. This satisfies your RMDs and avoids adding that income to your tax return. 2 birds, 1 stone. 3, tax-smart withdrawal strategies. Work with a financial advisor to create a withdrawal plan that pulls from your taxable accounts first, helping you delay RMDs and minimize your overall tax bill. The key isn't waiting until RMDs force your hand. The earlier you plan, the more control you're going to have. Here's the bottom line. Maxing out your 401k is not always the golden ticket it's made out to be. For many retirees, it creates a tax trap that eats away at your savings and leaves you less for the lifestyle and legacy that you worked so hard to build. The good news, you can easily avoid all of this, but it requires careful planning and a tax-smart strategy tailored to your goals. If you want help creating a retirement income plan that keeps more of your money in your pocket and not Uncle Sam's, book a call with me using the link in the description. We'll look at your 401k, your Social Security, and your entire tax picture to make sure you're not leaving thousands of dollars on the table. Don't wait until RMDs force you into higher taxes. The earlier you start, the more options you have.